Posez vos questions dans la langue officielle de votre choix. Please use the microphone in front of you by pushing the button and waiting for the green light. We'll allow one question and a follow-up the first round. Just indicate to me if you have a question and ensure to state your name and affiliation. So with that, I turn it over to the Governor for his opening statement.
Well, thank you, Jeremy. Good morning, everyone. Thank you for coming here to the Bank of Canada. Senior Deputy Governor Wilkins and I are happy to be with you to talk about the latest issue of the bank's Financial System Review, which we published this morning. Pour commencer, j'aimerais faire un bref rappel de l'objet de la revue. Nous y présentons les principales vulnérabilités du système financier qui peuvent interagir avec les chocs économiques et amplifier leurs effets. Nous surveillons l'évolution de ces vulnérabilités et examinons leurs répercussions potentielles sur le système financier et l'économie en cas de choc important. Le niveau élevé d'endettement des ménages et les déséquilibres sur le marché du logement demeurent les principales vulnérabilités du système financier. Celles-ci restent importantes et il faudra beaucoup de temps avant qu'elles reviennent à des niveaux plus soutenables. L'économie plus vigoureuse et les politiques publiques saines évoluent dans le même sens pour favoriser une atténuation progressive de ces vulnérabilités. Il s'agit là d'une tendance qui devrait se poursuivre. Permettez-moi de vous donner quelques précisions à ce sujet. Since the last FSR in June, household debt has continued to rise more quickly than household income. Borrowing for mortgages and home equity lines of credit is driving this growth. Further, we see that households with the highest debt relative to their income are carrying a growing share of the total. That said, new and pending rules for housing finance should help mitigate this vulnerability. Last year, the government introduced stricter rules for high-ratio mortgages, that is, where the down payment is less than 20% of the value of the home. These rules are continuing to improve the quality of new high-ratio mortgages. And fewer of these mortgages are being issued, particularly among highly indebted households. However, we've become increasingly concerned about low-ratio mortgages, those where the down payment is more than 20% of the value of the home. We're continuing to see an increase in new low-ratio mortgages that have riskier characteristics. More of these are being taken out by highly indebted households, and a growing share of borrowers is choosing an amortization period longer than 25 years. Last month, OSFI announced enhanced guidelines for low-ratio mortgages that are similar to the changes announced for mortgage insurance last autumn. There will be restrictions on borrowing from multiple sources to finance a purchase, and borrowers will have to show that they could handle higher interest rates. That's just good practice for anybody who is taking on new debt. While we can be confident that the new rules will help mitigate this vulnerability, their precise impact will depend on how both borrowers and lenders respond. We'll be watching this closely when the guidelines come into effect next year. Another important development since June is the bank's tightening of monetary policy through 2 interest rate increases, which came in the context of improving economic fundamentals. The effect of these moves on mortgages is complex. Roughly 15% of borrowers have floating rate mortgages, and they felt the impact immediately. However, interest rates on fixed rate mortgages only change when they are renewed, and about half of all mortgages will not reset for more than a year. Some of those that will reset next year could even see their interest rate decline, depending on their term. Improvements in the labor market, particularly stronger wage growth, should help households adjust to higher interest rates. But clearly, this is another area which we'll be watching closely. The second vulnerability, imbalances in the housing market, has also been affected by recent changes in government policy. Price growth has slowed in the Greater Toronto Area after the Ontario government introduced policies aimed at housing affordability. This slowing pulled down national house price growth to an annual rate of 10%. The Toronto area market is following a pattern similar to what took place in the Greater Vancouver area last year, where resales fell sharply and new listings rose after the BC government announced a tax on non-resident buying. It's worth noting that prices in the Vancouver area are once again growing more quickly than the national average. The bank will continue to monitor housing market imbalances closely, particularly for signs of extrapolative expectations. Higher interest rates and stricter mortgage finance rules should also help mitigate this vulnerability. However, the economic fundamentals of the Canadian housing market remain strong. Demand is being supported by increases in employment and population, and supply is being held back by basic geography and restrictions on land use. La troisième vulnérabilité concerne la cybersécurité. On le voit dans le monde entier. Non seulement les cyberattaques sont plus fréquentes, mais elles sont aussi plus graves et plus complexes. Les grandes interconnexions au sein du système financier impliquent qu'une attaque réussie contre une seule institution pourrait provoquer des perturbations généralisées. Nous collaborons avec nos partenaires des secteurs bancaires et publics pour faire en sorte que le système soit robuste et que les institutions puissent se rétablir rapidement en cas de perturbation. To better understand the potential implications of all these vulnerabilities, we examined the same risk scenarios as we did in June, and the risks are essentially unchanged. However, the policy changes affecting housing finance are clearly a step in the right direction. Still, it will take time for these, as well as the effects of recent interest rate increases, to significantly reduce these vulnerabilities. Meanwhile, our financial system continues to be resilient and is supported by improving economic fundamentals, in particular by strength in the labor market. And with that, Senior Deputy Governor Wilkins and I are happy to respond to your questions.
Thank you, Governor. So I've got 5 on the list so far. We're going to start with Andrea Hopkins from Reuters, and then Theo next, and then we'll go through the rest of the list. Go ahead, Andrea.
Yes, thank you, Governor. You mentioned a few times, you point to the labor market strength or growth. I'm wondering if you can speak to what might cause a turn in unemployment to the negative side, particularly with respect to NAFTA, which didn't get much mention.
Well, the outlook, as we've laid out in our most recent NPR, is for continued improvement in the labor market. But of course, we realize that there are risks to that, as there is for any forecast, and the risks we outlined in the NPR are not being updated at this time. And the risk around the future of trade and our trading rules, et cetera, around NAFTA is top of mind in that section. So that outlook, the macroeconomic outlook, is an important ingredient to our outlook here in the FSR. So they're kind of like twins, if you like. They go together.
You talk about how households have adjusted to the 2 rate hikes. Can you speak to what your expectations were and how that has matched up to your expectations, and how consumption more broadly and investment have also adjusted to those 2 hikes?
Yeah, I think it's just a little too soon for us to have a reading on this. This is not something that we can observe in real time, but more in the context of our models. How is consumption and housing investment and, of course, firm spending, enterprise spending, how are they lining up relative to our models, which, of course, have interest rates modeled in there? So it's only once we can monitor it in the context of a model that we can say to what extent the effects are as predicted. Is simply too soon. It takes 6 to 8 quarters for the full effect to work its way through the economy, and we're only a few months into this.
We'll go to Theo Argias from Bloomberg next. I've got Paul Vieira after that, and Raul and Courtney.
Good morning, Governor and Deputy Governor. It seems like we're a long way from the home capital situation. Residential investment is doing a lot better than anyone would have thought, let's say in March. And the Toronto housing market is If it's landing, it seems to be landing softly. Have you been surprised by the resiliency of the Toronto housing market over the last few months?
No, I've not been surprised by that. I think that the demand side of that picture is very clear. It's very strong. Continued high rates of immigration associated with high rates of job creation is the fuel for the demand for housing. And you could say something quite similar for Vancouver. Those two economies are actually growing far more rapidly than the macro economy, the economy as a whole. And so with that much demand, as well as the normal kind of supply constraints, whether it's the pace at which you create new areas for development in the Toronto area, or if you have actual physical barriers to development, as you have in Vancouver, you have the ingredients for higher housing prices in that situation. Would only be expecting, some sort of soft housing market if you had a downturn in the economy. There's, of course, the fact that the new changes that are being brought into play will have an effect on the margin, and we put considerable effort into analyzing that here. But some of those things are just coming into play now, so it would be, that's what we say, it's same as in the context of the NPR. We're monitoring how these changes affect the economy, and they're not the kind of changes that are, these variables don't change all the time, so they're not in your models in a statistical way. So you can't say, that's why we dug deeper into this to try and figure out if these policies were in place a year ago, how might have we model that? And importantly, you may have some, what I call arithmetic around that. That's not the same as an economic model, because when you do the arithmetic, you then have to ask, well, how will individuals actually respond to a situation where they discover they don't qualify under the new rules? Well, there are many ways to adapt to that, and only one of them is not buying the house. So we can put a maximum effect from those things, but almost certainly the effect will be smaller than that maximum effect, and we need to see the behavioral response before we'll know.
As a follow-up, I'm wondering if you could help us, if there is any, make a link between the Financial Stability Report and monetary policy. All things being equal, are easing financial system vulnerabilities more likely to make it more likely to raise interest rates, all things being equal?
Well, the way I think of it is that we're in a situation where all the things are working for us in the same direction. So there's no fundamental inconsistency. So you have an improving economy. That improving economy led us to take a couple of those interest rate cuts off the table. That's normal practice, because that's what an inflation target tells you to do. It's also a nice byproduct that those things work towards helping to reduce these vulnerabilities that we're talking about at the same time. Quite a contrast from where we were early in 15 when oil shock was happening, and we felt as inflation targeters we needed to cut interest rates, knowing that it was working in the wrong direction for the household vulnerabilities that we'd identified. But we have a primary mission, and we have, a secondary reinforcing mission, and that's when we emphasize that really it's other tools that should be brought to bear on household vulnerabilities, and so they have been. So.
Thank you. I've got Paul Vieira from the Wall Street Journal next, and Raul Vejinath after that from Epoch Times.
Good morning. Is there more of a sense of relief about financial stability? I got a sense from this report that there is at least a bit, some emerging signs that there's a bit more comfort with the state of play here when dealing with household debt and housing risks. Even though you suggest that there's a long way to go. Can you characterize this shift that's happened since the last FSR last review, and where we're how have things improved?
Well, I'll just start off by saying that the most important thing for us is that the vulnerabilities remain elevated, and these are not measured in decimal points. They're just elevated. And so that means that any shock that comes our way is going to be magnified by those vulnerabilities, and that's a concern for us. But just like when you're ready to make dinner, it takes a lot of ingredients to go into making that dinner and work besides. What we're pointing to is a couple of ingredients which are important to the final destination. Carolyn, would you like to elaborate?
Sure. So clearly, excuse me, household debt remains the biggest vulnerability for us. What we see, though, is a growing economy. We see some financial conditions that are less stimulative, and also some important changes to mortgage underwriting rules. Not only the ones that we did last year, that OSFI did last year, but the new ones that are coming in at the beginning of the year that will look at low ratio mortgages. And what we saw with what OSFI did last year, which was expected but also encouraging, is just to see how the quality of the new mortgage debt that's being written was increasing. And so just the share in high ratio mortgage space of loan-to-income ratios that were over 450% went from just under 20% to around 6%. So we expect to see a similar kind of improvement in the low ratio space, and I think that combined with a stronger economy really does speak to improving quality of debt and the sustainability of the debt. Now, this, of course, are the elements that are in place for that debt stock to really be less of a vulnerability. It didn't happen overnight, so it's not going to be resolved overnight either.
When you say it'll take a long time, when you mention in the opening statement it's going to take a long time to get to sustainable levels, what do you have a time frame in mind? How long do these policies have to be in? Do you have any sort of time frame?
Not really. We just, as Carolyn just said, we know when it takes 10 years to build up a vulnerability, I think the last thing you want is a rapid or sudden change in this. What you're hoping for is a gradual resolution, and that is where in effect the fundamentals do much of the work for you. So as I've said before, when we look at these vulnerabilities, what's the most important contribution that the central bank can bring to financial stability? Obviously, we're not in charge of all those rules and all that sort of thing. What we can bring, though, is our inflation targeting framework, which brings the economy back to equilibrium. And what that means is stronger job growth, more employment growth, more income growth. And so you're making things that looked unsustainable in a slow growth or a recession environment much more sustainable because the fundamentals are stronger. That's the most important contribution that we can bring. Now, as we said, we think that we're getting close to full capacity. We said this in the NPR. But that we think over the next year or year and a half, maybe 2 years, that we'll get more employment growth, more return to the workforce. So those things are all changes that will add to the sustainability of existing debt. It's not essential that debt, go down, but that we look at ratios, right? If the denominator goes up, everything gets better. And so. For us as macroeconomists, what we're looking for is for the next few years for housing and consumption to be less important as a motor of growth than they have been during this period where we've been stimulating the economy, and where exports and investment are playing the primary roles. And so over time, those things don't get worse, and actually over time they improve. But one last note is that I don't think it's very helpful to compare the level of debt today relative to income to the level of debt, say, 10 years ago or 20 years ago, which often we do, because the world has changed a lot. It's different people. The average life, where we are on the life cycle has changed. And the financial intermediation, which is done today, is so much more flexible. People are basically choose their own level of indebtedness more than, seeking permission to be indebted, as we did when I first got my first mortgage. And so that sort of thing has changed what I think might be the steady state numbers. So we're cautious about this. I mean, I can't say where the destination is, but of course we're all going to be reassured when our financial stability metrics are all improving for real. Right now we're more or less forecasting an improvement because we've got the ingredients coming together.
Thank you. I've got Raul Vajaneth from Epoch Times next.
Thank you. Good morning. Just in terms of the risk scenarios, you got the first risk, a severe nationwide recession, and it's said as elevated but decreasing. And so I'm just wondering if we interpret that with frequency and severity. So is it that the frequency of that is low, but the severity would be quite high, or such that the impact is elevated but decreasing? Is that how you interpret the elevated but decreasing for that first risk?
It's really where we're seeing the global economy going, as well as the Canadian economy. Over the last year, we've seen global economic growth across different countries become more synchronous, and where growth is being shared across a wider range of countries, including the emerging economy countries that were really hit hard by the oil price shock. And so what that means is that the likelihood of a really negative external event has gone down. If we were to experience that event, given the level of household debt and where housing markets are, probably would be just as severe. But when we do those stress tests, as we've said before, the Canadian financial system is highly capitalized and highly liquid.
Just a separate question, actually, is regarding the OSFI measures on the uninsured mortgages, and you had talked a little bit about the non-federally regulated lenders, and I also realized that there was, the industry wasn't particularly fond about the move naturally. And do you see in this case, significant migration to non-federally regulated lenders for low ratio mortgages, or how do you interpret what migration might happen?
Well, the analysis we've offered here on the micro level does give you a sense of the magnitude of those who in 2016 would not have qualified under these new rules. And so, as I said before, that would be sort of an outer limit on the likely impact, because we know that last fall, people are adapting to these changes. So when you're faced with that, based on this new criterion, you don't qualify. Well, I can go shopping for a less expensive house, smaller house, whatever, and then I'm still in. So requalify me like that. And so I think that's the first line of adjustment. And so there's at that point, no need to change lenders. But sure, there will be some, no doubt, that will migrate. So I'm just there'll be migration to other lenders. I just emphasize that these rules or guidelines that OSFI's put out are reasonable things for people to think about on an individual level. I mean, all this discussion that we put out here is about the lender. The lenders have rules, and so all of our analysis is about the financial system stability, right? Are there risks to the financial system, not about the risks to individuals. And, sometimes rules are actually a good idea from an individual point of view. So, if you were looking to go in the housing market, this is not a bad way to self-test. Could I manage if interest rates were to be 2 percentage points higher when I renewed my mortgage? I think that's a reasonable way for individuals to think of it too. So if migrating allows you to avoid the rules, I think it's still a good idea to do that stress test on an individual basis. So we know from these numbers what's the largest size that migration could be. I don't expect it to be large, but and the point is for us that if it moves to a different institution, it's still there. It's still a degree of financial vulnerability, just like before. So for us, it's a macro picture anyway. So, yeah.
All right, thank you. I've got Courtney Tower from Market News next, and then Andy Blatchford from CP after that.
I just have a couple of specific little things. You've talked in the past, both in the monetary policy report and in your speeches, given the idea that rate hikes are surely coming. Not sure when exactly, but the pace of the growth of the economy is such that they're coming. So then why would you not have this plotted as to its effect on borrowers and lenders, its effect on the economy? Surely you would work that into your thinking, would you not?
Of course, yes. So, in the monetary policy report, we addressed that in a bit more detail. We've actually respecified our model to have a much more elaborate modeling of indebtedness in households, including the term structure of that debt, which is to say, when do people renew? So we've got all that built in. And so the dynamics of interest rate adjustments and their effects on the economy are much more elaborate now. And having re-estimated the model, we know that the economy is more sensitive to interest rate moves given these levels of debt than it was before. So we know all that. We just don't know for sure if we've got it exactly right. We just know it's more than before. And it's what we say of course, in our modeling of the economy, when we have higher interest rates in our forecast, then they are playing the role, as you would expect, in the numbers that we present to you in the MPR. So they're in our base case. And so those effects, to the best we can capture them, are already present in the forecast that we give you. But when we say we might need to monitor in real time, it's to say, well, we can't be 100% sure the world's going to behave exactly as our model is, and so we're going to monitor that as we go up, and that's what we're doing right now. We're watching for signs of how people have adjusted to the 2 interest rate changes that we have already put in place, and that's it.
Okay, I guess.
Whoa! So I didn't answer your question?
No, that's fine. I have another little one. Home equity loans. I think this is a fairly new concern for you, or at least as you've expressed it. And 40% of such loans not keeping up with their principal and interest. Is that a growing and considerable concern for you? Is that a sort of an irregular thing coming up?
Well, that's what I was referring to a few minutes ago when I said that the financial system has become more flexible for people. They're able to choose their level of debt much more than before. Many institutions offer what amounts to a blended product. You get your mortgage. The fixed mortgage part is a certain amount, and then on top of that, they offer you part of your mortgage in the form of a HELOC. And that HELOC has different parameters. For one thing, it's not on a fixed repayment schedule, such as your mortgages. So you don't have you have no requirement to pay down principal on a regular basis. So it's there for you to, maybe finance a renovation, let's say, and so your mortgage goes up, and then when you pay back, you pay it back when you pay it back. But it's not formally part of your mortgage, but it is part of the. And in our data, it's part of the mortgage indebtedness. So one of the questions that raises is what are people doing with that capacity? If you're doing it for renovation, it's part of the value of the home and all that. But if you were using it to speculate, let's say to buy a second home that hasn't been built yet, on the prospect of selling it when it is built, because you can earn a profit doing that in a hot housing market, well, that's more concerning behavior, right? Because then you're vulnerable. You're vulnerable to a decline in house prices, or you're vulnerable to if you lose your job, that sort of thing. Would you like to add something about that?
I would just say that HELOCs are different from a mortgage as well, in the sense that you can use the value of your house to secure it up to 65%, but it has the characteristics of a demand loan, which means that it's callable, possibly. The interest rate on it can change at any time, as well can the total amount that can be extended, and so that flexibility is great when it's available, but borrowers need to know that flexibility isn't always there, may not always be there.
Thank you. We'll go to Andy Blatchford from Canadian Press, and we've got about another 5 or 6 minutes, so I might get a question or two in after that. Go ahead, Andy.
A NAFTA-related question. There's some new studies that should suggest the end of NAFTA and restoring tariffs might not be so devastating for Canada. I'm just wondering what your latest thoughts are on how severe the end of NAFTA would be for Canada.
Well, I'm not sure if I have any new thoughts on NAFTA, but just to summarize what we have said, we've highlighted as an important risk to our MPR in the outlook for the economy. We've always maintained that the effects of the actual, the range of possibilities of what could happen is too large for us to actually analyze it. But as a benchmark analysis, the sort of thing such as I've seen recently is, well, what if we go from NAFTA to WTO tariffs, which is where you reach the conclusion that it's perhaps not going to devastate the economy. And I've made this point before that if you're working under a tariff of 0 under NAFTA, and your tariff is going to be, on average, the WTO common tariffs are on average for Canada would be around 3%, thereabouts. Well, the Canadian dollar can fluctuate by 3% over a month, and that's the same sort of shock to a firm. So firms adapt to those kinds of disturbances all the time, and so it's not some massive structural change to the economy, but it is a structural change. So that what it means is that in the initial arithmetic, you could say, well, yes, it's not a big problem. But the question is understanding the dynamics. What happens next? Does a firm continue to operate under that new tariff regime, or do they choose to no longer invest in upgrading and expanding, and maybe invest in another country in order to adjust their overall cost structure? As for us, the most important channel, and the one we've modeled in our MPR, is the investment channel, because firms have already told us that they're holding back on investments till they have clarity on what NAFTA may look like. So it's the uncertainty around it that's concern. It's not about whether you face a 3% tariff or not, it's what do you face. And so that is already holding back investment, and we keep it in our outlook so that investment is lower than it would be without that uncertainty. And I have to believe that if there were a major change to NAFTA, it would be that channel, which is much more important than the trade channel that you're posing in your question. And so that's why we treat it as a macro risk, as it is. But that's the range of possibilities, I think, is a little too wide for us to be analyzing it. And besides, a lot of things, you know, I mean, you can have fiscal shocks in the middle of it. You can have, you know, exchange rates can move. There's a lot of things that can happen, which mean that you're forced to just assume things, and we don't like to assume answers. So we'll get a valid question someday, and we'll analyze the question. Would you like to add anything to that, or is that there you go.
Another one, because of this NAFTA uncertainty, there's also more emphasis on trade with China, and I'm wondering, but there are concerns about whether free trade with China would be a good economic option for Canada, and I'd like to know your thoughts. Do you think any free trade deal with China would lift Canadian growth?
Well, I mean, we already have a lot of trade with China, so we know that's been good for the Canadian economy, and by the way, it's in both directions. Right, it's important that, you know, if we're selling things to China, that China's a growing economy and they're growing at 6% or something like that, that's a great market to be in. And furthermore, their demands are going up the curve, right? They're, you know, machinery, equipment, specialized stuff. You know, I'm just reading a thing about in today's papers about clean tech, you know, a big market, you know, Canadian big clean tech sector growing nicely. So those are all any agreement which opens up more opportunities for Canadian companies is a good thing. That also opens up opportunity for us, right? So our consumers have less expensive things that are made in China, and that gives us more money to achieve our own personal plans. So trade, you know, I'm always going to say trade's a good thing. So trade agreements are usually a good thing. If nothing else, they give clarity to companies about what their rules are and what they face. And so if companies say, well, I'm interested in doing business in China, but I don't understand this or this, well, a trade agreement can help all those things. So that's a pretty vague answer, but you know, I have to say it's positive, but, you know, I don't have anything specific in mind.
All right, I think I had one last question on the list from Andrea, and we've got about 2 minutes. So, Andrea, over to you.
I wanted to ask you about something on page 7, where you say that a moderate increase in mortgage interest rates would be significant but manageable for most borrowers. And I'm wondering if that suggests you could have raised rates sooner or that you can raise rates more.
Why don't you go ahead?
We started to raise rates at exactly the right time, we thought, to achieve our inflation target. I think the analysis that we did was really a micro-analysis that was a bit of a double check on the changes in the models that we did to just really keep in touch and be as precise as we can about what the effects of the interest rate increases that we did would have on households. And so you'll see in the report we were pretty careful to look at the distribution of borrowers. As you know, everybody in this room probably is going to be affected differently by an increase in 25 basis points in the interest rate. And so what we see is not surprising that, you know, a typical borrower in Canada would have a mortgage of about, $225K, an income of $90, and then that would have an effect of about 1.5% of gross income per month on their debt service, which is, you know, not insignificant but manageable. There's another proportion of borrowers, though, that are hit a bit harder, and we have an example for them as well. And so that kind of macro analysis and looking at the full term structure of interest rates that goes along with it allows us to better understand how households can adjust over time. And what we see is that it's more difficult for some than for others, but the macro outcome for that is something that will allow that adjustment to be made over time and for the economy to continue to grow.
I just add one more complication because, you know, it's not a simple matter, and that is that as interest rates rise, at some point what we also get, of course, is movement on deposit rates. Okay, well, we were, down at rock bottom for quite a while. So it's sort of a slow-moving thing. But actually, the vast majority of households in the economy aren't carrying mortgages. They're actually carrying assets. And so their income will be expanded by higher interest rates. And so when we look at the interest rate sensitivity of the economy, it's a blend of both people with debts and people with assets, and it's kind of a net effect of many things. So it's a single parameter in our usual models. So given the importance of this issue, given where we are, that's why we made this investment over the last 6 months or so to add more richness to our model, so we capture more of these dynamics on the debt side. But it shouldn't just focus on just that, because there are people out there who've been, actually the majority of the mail that I receive has been from people who are upset about how low interest rates are, not about how high interest rates are. And so I have to believe that those people are, as they go in and their GIC matures and they get another quarter or half point on their GIC, they're going to be pleased about that, and they may adjust their spending in response to that too, in the opposite direction. So.
All right, thank you very much. That concludes today's press conference on the financial system review. Thank you, Governor.
Thank you, everybody.
Senior Deputy, have a great afternoon. Thank you.